The Fed's interest rate cuts will cause some dividends to shrink, like this one. I'm selling those. And rate cuts will cause other investments to grow in value, like this one. I'm holding on to those for now. And when the price gets high enough, I'll replace them with other higher yielding opportunities to grow my income. Today, we'll look at how rate cuts affect income investments. Welcome to the new look. Hope you like it. Let's spend 1 minute on the big picture regarding rate cuts, and the rest of the video will dive into specific examples. Lower interest rates are generally good for the stock market because access to cheaper money makes it easier for companies to grow. They can borrow money to grow by building new factories, opening new offices, buying more inventory, buying other companies, etc. In general, a Fed funds rate of 3% would be better off for the stock market than a Fed funds rate of 6%. But rate cuts don't happen in isolation. There's a lot of moving parts. The reason for rate cuts really matters. If the Fed is cutting rates to escape a recession and fails, then the recession and everything that goes with that, like unemployment, loss of consumer confidence, might be more impactful than the rate cuts themselves. I'm going to assume that these rate cuts successfully avoid a recession, so we'll focus on the effects of the rate cuts, not the effects of the recessions that sometimes coincide with rate cutting periods. We should also make an assumption about how low rates will go. No one actually knows, of course, but instead of me guessing, I'll use the estimates from Fitch Ratings, which are an additional 1 or 2 cuts this year, 2024, to bring the Fed funds rate down to 4.5%, then a total of a 1% reduction in 2025 and another 0.5% in 2026 to reach a target of 3%. In other words, slow and steady cuts. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth. And this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. Here are some income investments that are likely to benefit from rate cuts. We'll start with leveraged investments. Whoever borrows money to make money can now borrow for less. Who borrows a lot of money? Real estate investors. For example, RLTY is a closed-end fund that holds a nice basket of real estate companies like American Tower, one of the largest cell phone tower companies in the world. They own 250,000 cell phone towers. RLTY also owns Prologis, one of the largest industrial REITs in the world with over 1 billion square feet of warehouse space. These are companies that will be able to grow their portfolio faster with cheaper money. I started buying RLTY earlier this year when it was yielding above 8%. It has appreciated since then, so the yield isn't as attractive right now. It's a little bit less than 8%. If that trend continues, I'll rotate into something that pays more. Another sector that borrows a lot of money to expand is utilities and its close cousin, infrastructure. Those power plants are pretty expensive to build. My favorite player in this sector is a fund called UTG. High interest rates were not kind to utility-focused investments like UTG, but recently, that trend has reversed, and the total return over the past year for UTG is a staggering 50%. The two examples I just gave, RLTY and UTG, benefit from lower interest rates in 2 ways. First of all, the companies in their portfolios can use cheaper money to grow faster. Secondly, both of those funds are leveraged. In other words, the funds borrow money to magnify the income generated by all the individual holdings. The cost of that leverage is also coming down. Another category positioned to benefit from lower interest rates is fixed income. These include corporate bonds, corporate loans, and the example we'll look at in a second, fixed rate preferred stocks. If a preferred stock is paying a fixed rate of, say, 7%, maybe that didn't look so exciting when treasuries were paying 5% with no risk. But the closer treasuries get to 3%, the more enticing that 7% starts to look, so investors will pay more for it. Preferred stocks are complicated to analyze, so my go-to investment for them is a fund with the ticker PFFA. It's currently yielding 8.7%. Over the past 5 years, the total return has been not great because of higher interest rates, but if we look at the past 12 months, we can see that PFFA has caught a tailwind. This fund actively manages roughly 200 preferred share investments, and they're a mix of fixed and floating rate shares. The floating rate preferreds delivered higher income while interest rates were elevated. Now that dynamic is shifting. As interest rates fall, the floating rate preferreds will deliver less income, and the fixed rate preferreds will appreciate in value. I'm assuming that the portfolio managers will maintain a good balance between fixed and floating rate shares in the portfolio. But if you want to do it yourself and buy individual preferred shares, I suggest reading the REIT Forum's detailed guide to preferred shares, link in the description, it's free. Let's move on to the third category to benefit from falling interest rates, growth stocks. These are mostly focused on technology and feature the household names that dominate the stock market like Apple, Microsoft, and Nvidia. When growth companies borrow money, they can put it to work and generate a high return on their investment. Maybe they build a data center or a chip factory. The cheaper it is to borrow money, the faster they can grow. Usually these companies pay little to no dividends because they're growing so quickly that it makes more sense to reinvest earnings back into their own business rather than distribute it to shareholders. For retirees like me who want consistent income, these stocks don't pay the bills. But there are funds that turn some of that growth into income. A couple of examples are STK and BST. These are actively managed technology-focused funds that are designed to deliver a hybrid of income and growth. STK is yielding just under 6.5%, a bit low for my taste, but the income has been very consistent, and I like that. This distribution chart goes back to 2010 when the fund began. The spikes are special distributions, and that small line wasn't actually a cut. It was just another special distribution. BST pays a higher yield than STK, currently just over 8.5%, and they've raised their distribution several times. Like STK, BST has also paid out some special distributions, a nice bonus. This distribution chart came from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, check the yield on cost, and most importantly, know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. I currently hold a small amount of BST, but as I record this, I'm looking to increase its weighting in my portfolio because it's currently trading at a discount of more than 6% to its net asset value, which is not a bad deal. If you want to learn more about STK and BST, I'll link my reviews in the description. Here are the categories that I think will remain unaffected by rate cuts. We'll breeze through these fairly quickly. First up, business development companies or BDCs will generate less floating rate income, but they'll also be able to borrow money at lower rates. Most importantly, the risk of borrowers defaulting on loans becomes less as rates get lower. I did a deep dive on the effect of rate cuts on BDCs recently, so we'll leave that one right there. The second category I'd classify as neutral are actively managed credit funds. These funds typically hold a mix of corporate bonds and corporate loans. An example is FSCO, currently yielding over 11%. This fund has profited from a portfolio weighted towards floating rate debt. As interest rates fall and fixed rate debt becomes more valuable, I expect that weighting to gradually shift towards fixed rate debt. The third category I'd consider to be neutral are covered call index funds like SPYI. These funds use options to sell some of the upside of their potential appreciation. In exchange for giving up that upside, the call options they sell bring in revenue every month. SPYI is based on the S&P 500 and it's currently yielding just under 12%. By the way, these three categories make up the largest percentage of my portfolio. In other words, I don't expect rate cuts to have a dramatic impact on income investing. Today's episode is really about making some minor tweaks here and there. So let's wrap up with the losers. Rate cuts will have a negative impact on floating rate investments. For example, I've been trimming back my floating rate preferred shares like AGNCN, currently yielding just over 10%. You can see the distributions rose dramatically as interest rates rose, which was nice, but it's not going to last, as explained by this article written by the Colorado Wealth Management Fund on Seeking Alpha. If you're an income investor, Seeking Alpha gets you access to more research than any other website or app. I'll put a link in the description to the article I just mentioned and a link for a free trial and a discount. I'll also link to this video that walks you through the 4 features I use to analyze income investments. Those AGNCN preferred share payouts are tied to the Secured Overnight Financing Rate, also known as SOFR, which is on its way down. The other issue with floating rate preferred shares is that if they're callable, which many are, there's a risk that the company will buy them back at $25, which they're entitled to do, so that they can issue more preferred shares at a lower interest rate. That means holding callable preferred shares valued too far above $25 comes with added risk. The other category that's feeling an immediate impact from rate cuts is, of course, short-term treasuries. I don't invest in those directly, but some of the funds I own do. For example, SVOL is currently yielding over 16%, which is great. Most of the income comes from trading VIX futures. However, some of the income comes from the short-term treasuries they hold in the portfolio. SVOL recently cut their distribution from 30 cents to 28 cents because they're now earning less from those treasuries. I still like SVOL as an alternative income investment, and I didn't expect the income to remain at 30 cents forever, but the lower interest rates go, the lower the potential income for this fund. As I record this, I don't plan to sell SVOL, but if you're watching this video far enough in the future, perhaps something has changed. So if you want current information on my portfolio, click the link in the description for Armchair Insider. It comes out about once a month and it's free. To put things into perspective, income investors have enjoyed a nice run recently. Yields have been higher than normal because of high interest rates. Some yields will come down, so I expect the average yield on my portfolio to drop slightly. On the flip side, though, as investors dump their short-term treasuries and hunt for higher yield elsewhere, the valuations on some of these income investments will be increasing. It's already started to happen. An example is I recently sold HESM for a few reasons, but one of those reasons was that the price went up so much that the yield became less attractive. Specifically less than 8%, it made more sense to rotate into something else that offers more income, like EIC at a yield of almost 15%. Also, yield has to be viewed in the context of inflation. I'd rather have a 10% yield and 3% inflation than a 12% yield and 6% inflation. Spending power after inflation is what really counts. Now, I've mentioned selling a few stocks and funds in this video, and if you're curious about the strategy behind selling to maximize income, then click this video over here. It explains it pretty well. That wraps it up for this look at the effect of rate cuts on income investments. More Armchair Income coming soon. Armchair Income, that's my hustle.